So the model that we're doing today is the 5-minute Q3. The point of this model is to catch the 4-hour expansions. So this is the chart that Adrian has provided as an example. You can find this chart in his channel. But basically, we're looking for a 5-minute change in state of delivery, and we are going to be focusing on the change in state of deliveries or manipulation zones that occur within Q3 preferably, mainly because the data that Adrian has been able to collect shows that Q3 will deliver to 2 standard deviations, high 80s% of the time. I don't have the exact sheet in front of me, but it's high 80s. Now, with that being said, if the manipulation occurs during Q3, but we return to the zone outside of Q3, we can still take that trade, as long as it's in the form of a 2, a 4, or a 5 type of entry in regards to SBS, if you guys are not following what I'm saying. If you're not familiar with what we're testing, or you need a thorough walkthrough of the model, you can watch the last video that Adrian and I recorded together, which was on Thursday. Hi Nicholas, you can find that video within his channel in the Discord or on his YouTube channel. So we are focusing again on Q3 manipulation zones. Generally speaking, like let's say this is a Q4 manipulation in this picture, in this example, but if a Q3 manipulation occurred here, let's pretend, generally speaking, it will consolidate for Q1 through Q2, and then in the next Q3, it will return and wipe out 2, right? And so generally speaking, a Q3 entry will also occur from a Q3 manipulation zone, and we actually went over a couple of trades of using that example on Thursday, because the trades that we took on Thursday were actually that exact situation. Now, this actually looks exactly like the Thursday price action that we caught, to be honest with you. Now, with that being said, I did add a category here, because considering that we can enter in different quarters based on where 2, 4, and 5 occur, I did actually add this Q4 entry, even though we're only taking Q3 manipulation zones. And again, we're looking to reach the full standard deviation, which we're only aiming for 2, but we're reaching for the full deviation of that Q3 manipulation zone within this quarter, within this 4-hour candle is ideally what we want to see. So in this example, we have this 4-hour candle from 2 to 6, technically 6 p.m. when we open back up. So that 2 to 6 candle was a bullish candle. This candle was an inside candle. And then the next 4-hour candle from 10 to 2 is now closing bearish, and we're looking to capture this expansion using this model. All right, so just for further expansion, we're looking 5-minute change state delivery. Then we will mark out OTE of the expansion out of this manipulation zone, and we are drawing the standard deviations from that zone. Once it returns to OTE paired with some sort of PD array, we can then take entry 2. If entry 2 expands, then we can the TPs are in order 1.5, 2.5, 3.5, 4.5. The next entry we can take is 4, and then 5 isn't pictured here, but let's say we can take this entry 2 as well, as long as it's returning to the zone with OTE. Sure, Yerm, go ahead. Fire off. Let's get started. Obviously, if you guys have questions, feel free to ask away as well. We're gonna start with all of 2025. So we're gonna start at the very beginning of this year. I don't know if there's gonna be enough examples to sustain us from January till now. since we're only taking Q3 manipulations. So we'll just have to F around and find out. To currents. So the reason I'm on FX replay is because I know off the top of my head that TradingView likely doesn't have this data. I can verify just to be sure. So in that drawing, we've drawn the standard deviation levels for that manipulation happening in Q4. Isn't the standard deviation levels that we draw from the manipulation that happens later in that following Q3 what we're looking at, I assume is what you're trying to say. In other words, what relevance is that manipulation? Well, Adrian trades all quarters, right? So that's why that's the example. But I've opted to only test Q3. I mentioned that in the last video, is that I'm making the executive decision to only test Q3. So although this is exactly how Adrian would trade the model, I'm suggesting that we only do Q3. One, because I'm the one sharing my screen and what I say goes. Two, because the data shows that Q3 manipulation zones are what deliver most to 2 standard deviations, and being that we want to catch the expansions of the 4-hour candle, it makes sense that we go for the highest probability quarter expansion. So let me just open up that link. So this is the data here. All of you can see that, I assume. Oops, sorry, I closed it. Q3 here, 2 standard deviations delivers 82% of the time in London. Sorry, 61% of the time. Q3, 51% of the time. Q3, 36% of the time in Asia. So these are the sessions, right? And then these are where that manipulation is originating from, and these are the deviations that are delivering. So Q3 holds the highest for all except for New York. Oh no, yeah, it delivers 80% of the time, 93% of the time it goes to 1.5. Okay, so that's just a drawing illustration that what Adrian generally is teaching and trading, not necessarily what we'd be testing. Correct. Because Adrian will take, if you go to his channel, for example, Adrian will consider the manipulation happening from all quarters. So I don't know if anyone has ever taken the time to read his channel or look at the charts that he so thoughtfully maps out for us. But sometimes it'll say Q1 manipulation zone, Q4 manipulation zone. Granted, most of the time Adrian is only taking an entry from Q3 ideally, right? But if SBS, for example, is playing out, but the manipulation originated from Q1 or Q2, he's going to take it every time. And it just so happens that Q3 generally is the quarter that offers the entry. So the manipulation probable to happen in Q3, the highest amongst all of them except for Asia, and then what deviation is being delivered, more than likely 2 standard deviations from all of them. And these are things that we'll see, right? We'll be able to confirm or deny these things. When we see a change in state of delivery occur on the very vertical lines that demarcate Q3, the start or the end, are those still considered happening within Q3? So Q3, if it's at the start, yes. If it's the line that ends Q3, then that's technically Q4. Because just like when we look at an hourly candle, for example, let me bring up these quarters. all the Q4s. So Q3 starts at, that's probably a bad example because Q4 is cut off. So Q3 starts at 9 a.m. Q4 would be at 10:30, right? This 10:30 candle is 10:30 to 10:35. So this would be the following candle, just like the candles, since it starts at 10:30, it's not considered Q3. If that makes sense. Just like an hourly candle, when you have the hourly or the down here. If it's landing right on 11, it's the 11 o'clock candle, not 10 o'clock candle. I think that's what you're asking me, right? Sweet. Any other questions? Take your time. I like it. Sure. You can just ask away, Yerm. You don't have to give me a heads up that you're asking another question. No, it's okay. Oh yeah, okay. Sure. Understood. Point taken. I often see times when a large manipulation leg occurs in Q2, and we then see the change in state delivery occur in Q3. In that case, that's a Q2 manipulation. Yes, so it is, but if we see another CSD occur in Q3, then that is also a Q3 manipulation. So let me just delete everything from last week. Sure, I don't need it anymore. Okay, so let's use these quarters for example. Let's say price is lollygagging, having the time of its life, and then we have this huge manipulation occur during Q2, and then it doesn't do anything, and then we get another CSD occur in Q3, right? So, and we can even like have this return to the zone, for example. So although this is a Q2 manipulation that price is delivering from overall, right, there is still a manipulation and change in state delivery occurring in Q3. So this would be our new manipulation zone, and all that happens is that, let me move this all the way up, all that means is that because these standard deviations haven't been met in Q2, we just keep them on the chart and we let those deliver, as well as we have a new deviation that we can refer to and we let that deliver. Because also look at what's happening, right? Q3 is ending a 4-hour candle, 6 to 10, and then once this opens up, once the 10 a.m. candles opens up, this will more than likely be the continuation, or it'll completely run stops on this Q3 manipulation and return to the zone of Q2, right? So that can happen for sure. And this would be a 1, 2, 3, right? And then 4, taking out 2, and then, you know, I missed one, the 5. And you literally, Yerm, if you just scroll through Adrian's charts, you'll see plenty of examples of that. And on Thursday's price action as well, for the trades that we all took in AM session, that's exactly like it. It doesn't mean that this is not a manipulation zone. This is still a manipulation zone. This is also a manipulation zone. Okay, I mean, you can just go ahead. We haven't started testing, and probably everyone has these questions. They don't know they have these questions, so just go ahead. I'm happy to run the timeout with questions. Guys, if you guys have questions, feel free to pop off as well. Yes, because, so for example, because this manipulation zone is happening here, this would technically, this can be an SBS from the Q2 manipulation, right? And we won't be considering this for an entry at this point if there is no Q3 entry. Oops, I clicked out of it. So let's say this manipulation doesn't occur during Q3. Like we don't clearly take out any sort, or we don't make a new CSD and we don't manipulate above highs, right? So if we're not, which is actually, so yeah, so we won't take this entry here. Even though we have an entry occurring during Q3, we won't take this entry here. Like, sorry, let's say we don't have a manipulation. Let's say it's just like this. Let's say the Q2, I don't know, goes back to the zone. And Q3 just dies off. We will not take that entry. So, okay, this is a better example, or let me clarify here. When you have a Q3 manipulation, right? That means that all the quarters before that have, oops, wrong one. All the quarters before that have more or less consolidated, and Q3 went up and made the highest high. Okay? So the previous manipulation, like let's say this is happening in Q2, the previous manipulation is going to come, damn it, I keep grabbing the wrong one, is going to come from the previous quarter, right? And then, you know, I don't know, so whatever happens here, and then it comes back up, right? So if there's no Q3 manipulation in the same quarter that there's a Q2 manipulation. Unless, you know, I have yet to be proven wrong, but we'll see. We just, so the most current deviation, or we do consider both. So let me, I would have to start bringing up old charts for that. Let me see if it's on Adrian's example here. Okay, yeah, perfect. So see here, this is a Q4 manipulation from the previous quarter, from the previous cycle of quarters, right? Then we have a whole new cycle here, Q1, because it's from PM session. So we have a whole new cycle happening here. Q3 is manipulating into the previous cycle's Q4. So there's not a Q2 manipulation and a Q3 manipulation in the same cycle, in the same 4 quarters, right? But see here, these deviations have not delivered yet. And what happens at 1.5, 2.3, 3.5, and 4.5, Adrian, I mean, Jeremiah, since you've been attending the sessions, what is supposed to happen at these levels? Right. So that's how we're considering all, because then this reaccumulation is going to occur in this area, and then we're going to have a manipulation above that reaccumulation, and then we have new deviations to refer to. And it happens over and over again, generally speaking, at all of them. So the kind of like framework or the foundation for all of this stems from a market maker buy model and sell model. I'm not going to make it too complicated, but as a very crude depiction, let's just pretend that all these quarters or all these times are different quarters. But you would have a manipulation up. This goes to 1 to 1.5 deviations. You have a new manipulation or a new accumulation, and then another one, and then it goes over and over and over again, just like that. And this is like a very simplified, crude depiction of continuations happening over and over, originating from one deviation. But every single time that happens, we have a new deviation to refer to. And then when this is met, for example, when we get all the way down here, but we're within this reaccumulation or redistribution for this second or third deviation, generally speaking, these 2 and 4s will always meet up, right? So 4 is what we consider in ICT world like your max extension, or this is high probability when you should start to see a reversal. 2 to 2.5 is a high probability retracement, and it can be a reversal, right? But if you have continuations offering confluence saying that you're going to continue to go lower, or we get to here 2.5 and we body through all of this, and then we have a manipulation that doesn't cause a new change in state of delivery bullish, then we can assume here that this is also going to continue to 4 or to 2 of this one. And then at this point, it definitely becomes high probability now that you have a reversal occur that causes a change in state of delivery in the opposite direction. So in that Adrian drawing, are we simultaneously postulating on 2 different sets of standard deviations, the one from the previous Q4 and the current one from the current 3 manipulation, or is there a kind of hierarchy, if you will, where the previous larger one is somewhat governing? So we are going to be referring to the most recent one because of the current 4-hour expansion, right? So, but the first one, manipulation, when do you draw it? In the beginning of the week. Nick, you're gonna have to watch all the previous videos. There's at least 2 where we go over the model in depth, but you just draw the manipulation when it occurs. There's no set time, right? But you're drawing the manipulation that's occurring within Q1 to Q4. And again, guys, for the love of God, please study Adrian's channel. Just go over, take 10 minutes, 15 minutes, just go to Adrian's channel and look at all of his charts, right? But we are looking specifically at manipulations that are occurring between Q1 to Q4, and these are not the micro cycles that JD is trading. These are the 90-minute quarters. So quarter 1 is 90 minutes, 6 to 7:30. Quarter 2 is 90 minutes from 7:30 to 9. Every single quarter is 90 minutes. It's not the same quarters that JD is trading. So whenever that manipulation occurs, we are drawing that manipulation, and a manipulation for crude depiction is this: when you have a consolidation, then you trade above. Let's just say that you have a range, right? You have a range, and when you trade above that range, and then you trade below that range, that area is a manipulation. Likewise, if it were reverse. So if you are having a range, and then you trade below that range and then back above that range, you can safely assume that this area is now the manipulation. This is M5, yes. We can even go to Adrian's channel together, right? Let me just do this. And Adrian has been a part of Kingline for over a year now, or a year because he joined slightly after me. So he has a year of charts in his channel that everyone should and could be studying, and he always tags everyone here, right? So here we'll pick a random day. We'll go to the beginning of the year, since that's where we're starting. We're gonna spend, it's 12:30 now, we're gonna spend 30 minutes studying these charts. All right, January 2nd. Okay, so this chart here, he has all the quarters marked out. Here is a Q1 manipulation. He's drawn the deviation from that Q1 manipulation, and then it never returns to the zone in this instance, right? So Q1 manipulation, it goes up. This would be a mistrade for us. This was also a mistrade for him, obviously. And then when we get to Q3, notice that Q3 here has traded above the high created during Q1. So this area manipulated outside of this area. That's really easy to see, right? This is all within one range. This manipulates out of it and manipulates back above it. We can now assume that this is a manipulation zone. Up until this point, we trade above it and then we trade back into it. And this is the trade that he opted to take. This looks like it was a continuation higher, from what I can see, from what I can tell. But he sees the change in state delivery during Q3. It returns back to the zone. That's his model. He took it and it did not deliver, not even to one deviation. Okay, so now let's go over the summary that he wrote to go with this chart, right? So Asia setup, it was a 2.8 to 1 risk setup, so it was a 2R trade, right? And he took a 29-point loss. It was a Q3 manipulation into the 4-hour SIBI is what is the idea that he wanted to target. It was a New York PM high sweep, so we came above this high here. We swept it, and then we had a Q3 manipulation in which a change in state delivery occurred during Q3. Then there was displacement because a fair value gap printed within that, right there. And then we had an entry at the 5-minute SIBI plus the 1807 digital time theory candle, and he was targeting 2.5 standard deviations. So any questions about this example here? But every single, he's telling you exactly what he was doing. We were in H4 SIBI, we swept PM session high, there was a change in state delivery, and there was displacement. Everything met his checklist. He took the trade and followed his system. All right, so then now we move on to the next chart, and this is a review of the entire day now, right? So in Asia, let me do this. No, I can't do that. No, because I have to keep showing you guys. All right, I'll just click back and forth like I've been doing. All right, so let's go over Asia first. We have an expansion to previous day low, a change in state delivery in Q2, Q3 continuation, Q4 consolidation. So in Asia here, oh yeah, this is the trade that he took right here. So this is a review of the entire day after he shared his trade review with you. So we expanded into Q1, right? Then we have a confirmed Q2 manipulation because that's when we have this change in state delivery here. So although we expanded down during Q1, we didn't get the close above for the CSD happening during Q2. So then London, wait, what do you say? Q3 continuation. It continues to expand higher. And then Q4 consolidation because it just trades back into the range. And it doesn't close higher here on this close. It's still within this Q3 range, right? So Q4 consolidation. Now the next session would be London. So it would be this area here. And he says for London, we have a Q1 continuation to standard deviation 1, Q2 consolidation, Q3 manipulation back to Asia high, Q4 consolidation. Ooh, that's gross. So in London, we had a Q1, you said continuation? Yeah, okay. Q1 continuation to SD1 from this original standard deviation, right? That has not played out yet. So we had a continuation to Q1. Q2 consolidated because it traded right back into the range. It did actually, yeah, it closed within Q1 here. So we just stayed inside of Q1. And then Q3, we have, what did he say? Q3 manipulation back to Asia high. So we manipulated down to Asia high, right? And then Q4 consolidates within that. So notice we manipulated back down, right? There is a change in state delivery here, but it's happening at 1 to 1.5, right? So this here, it's either going to be a reaccumulation, or if this is not on trend, this can very well lead to a reversal at this point. So 1 to 1.5 is the deviations that are generally met when we're trading against a trend. But notice here that when we have this change in state delivery occur, there is no displacement after that CSD. So we just have that change in state delivery, but we continue to trade higher. So then Q4 is just a consolidation inside of Q3. In order to have a new change in state delivery bullish is when we get this close above here, there, right? So in this case, so what ends up happening is as we close above that, we then do not have any displacement higher, and it just breaks down. So then it invalidates this change in state delivery right away. As soon as we get this new close below here, we have a new change in state delivery, and then you have a CSD happening there as well, and then it trades lower. So then the next session that we refer to, sure, yeah, go ahead, hop on.
Can you hear me?
Sure can. What's up?
Okay. So in this example that you're showing, so when that Q3 manipulation occurred in the London session, that then didn't actually deliver. I guess what I'm asking is, it seems so. You said that you were kind of weighing the manipulation that occurred before the prior one, the one that happened, yeah, that one, right? And you're saying that so there was like some kind of logic around how you're not gonna take, or you're like considering how this is a Q3 that's happening in London, but then it could just very well be a reaccumulation that's happening from the previous standard deviations, right?
Yes.
So in this case, or I guess what I'm asking is, are we just are we weighing that in our testing, or in our back testing, would we just kind of treat each one independently?
Yeah, so each Q3, like if this, for example, this here, because this Q3 is happening here with this, we would have to have the confluence of previous day high, previous day low, right? So that's the only context that we're providing, which is why in the rule set we have the daily setup portion. When we went over the model, when Adrian presented the model to the group on Thursday, like the actual ways to take the steps and how to approach it, we're always going to consider the daily context of it. We're not necessarily going to refer to the previous quarters, right? But there is, I guess, an exception in that if the previous Q3 manipulation deviations were not met, and then we have another Q3 or the Q3 entry happening within that, then we're still going to abide by that Q3 that originated from the previous, cycle.
Okay.
Does that make sense? Because we are referring to Q3 manipulations, but we're not referring to Q2, Q1, Q4 manipulation. So it's specifically where the manipulation occurs that will provide context to our current trade. Because we can take the trade in any quarter as long as it's an idea that's originating from a Q3 manipulation.
Okay, and can you reiterate again on the Q3 manipulation that we're looking at in the London, like this London session here? the one that have yeah that one.
Mm-hmm.
Could you reiterate uh straightforwardly again, like how does this one not fall into the criteria that we laid out in the rule set?
So, in my opinion, this would be something that does follow the rule set.
Okay.
Because here, let's see, or for let's say for our test, it does it would lead to taking the trade for sure.
Okay.
There's displacement here in this fair value gap, right? But
Yeah.
then the only thing that would invalidate this is when we get to this close. So this would just straight up be a stop out in this instance. But
Yeah.
here the reason that he didn't take it is because it's manipulating down into Asia high and true day open from a bullish manipulation that occurred before that. So
Okay. Okay.
in our data, this is just his discretion saying that he's not going to take this trade. But in our testing, we would take this as an example.
Okay. Yeah. Got it. So yeah, I guess that's what I was just trying to get at. It seems that for our testing purposes, we would kind of mechanically do it. However, perhaps in real life, there's a lot of, I guess there's a lot of layering of confluences or other ideas that might be, but might be occurring that might govern our real time decision making. So I'm
Yeah,
just acknowledging that it seems that we'll be operating somewhat like more mechanically and differently from maybe in real life when we don't really know the future.
yeah, 100%. So like, as always, our testing will always be yes or no. There's never gonna be discretion applied to it. And if there
Okay.
is discretion, then we try to eliminate that through yes or no instances whenever we do that, or if then instances. So now let me just provide extra context here. So I don't know how the day closed on previous day high and low, right? But based on what I can see in this chart, it looks like previous day low is here and previous day high is there. And since he's drawn, no, this looks like OTE of this range. So he doesn't have OTE on this previous day, right? But what we would do is we would draw OTE here. And in order for us to take the trade, the entry has to be within the manipulation zone as well as OTE, right? And
Okay.
that's gonna be the context of where we're taking. So like anytime we're taking a counter trend trade, for example, we can take this Q3 as long as we're targeting OTE or we're trading out of OTE. So that's how the daily will provide context.
Okay. Got it.
Okay.
I did have another question, but I
Patiently.
didn't want to interrupt like
Sure.
the main flow of um, how you're reviewing these charts. So um, I guess I can wait if you want to continue going through um, some of the charts.
No, go ahead. Shoot.
Okay. Um, I mean, I guess it's not. I'm trying to get understand the relationship between the so like because as I understand each quarter is 90 minutes, and then if there's four quarters, if there's four quarters, that's like 6 hours, I believe.
Mm-hmm.
Um, right? Am I right on that?
Yeah.
Yeah. So, but then there's
Sorry.
also kind of
3 hours.
sorry.
3 hours.
Oh, four quarters, 90 minutes per quarter. That's 360 minutes, right? And then 360 minutes divided by 60 is 6. So 6 hours, right?
6 hours. Hold on. 1/2. Oh yeah, 6 hours. Sorry. You're
Yeah,
right.
but
6 hours.
then
Mm-hmm.
I haven't quite made the connection to the 4 hour candle. Can you help me understand that? Like the relationship between these quarters and the 4 hour candles, or like the 4 hour the
There
4 hour
there is
candle.
no direct relationship for the quarters to the 4 hour candle, but there is a relationship between the 5 minute CSD to the 4 hour expansion, right? So because we're looking at a 5 minute CSD, we're just focusing on when that 5 minute CSD occurs, and that's going to be within Q3. And then we're looking to use that 5-minute CSD that happened within Q3 to catch the 4-hour expansion.
Okay, all right.
So let's just go back to this example here for the chart that Adrian provided. So notice where Q3 falls generally, right? So Q3 happens here from, what is that, 21? 9 to midnight is the next cycle, right? Or 9 to 10:30 is the next quarter. So the 4-hour candle starts at 10. So Q3 falls within the beginning of that 4-hour candle expansion. And then when that 4-hour candle opens, and then when we have the 5-minute change of state of delivery happening at the beginning of that 4-hour candle, we're then looking to take the entry that occurred during Q3 to catch the 4-hour expansion.
Okay, so then, would it is it just kind of like the coinciding, or like the confluential coincidence of like, when that new hourly, or I guess 4-hour candle starts, that I guess on that 4-hour candle, it kind of looks like it's wicking maybe like the top, or like the previous candle's wick or something like that.
Yeah.
And then that's kind of like the manipulation, but we kind of structure it lower time frame at the 5-minute level. Is that
so that, I mean, so basically what we're looking for on the 4-hour chart, right, is we're looking to catch the expansion, for example, of this candle. But really, let's just use a 4-hour candle. We're just looking to get in the 5-minute change in state delivery that happened during the wick. That's really it.
okay?
So the candle will open, right? And then we have a 5-minute CSD below in this example. And then, or we trade down, right? And then once this 5-minute CSD occurs within this 4-hour candle, then we're looking to catch the expansion on the way up, or vice versa.
Okay, so it's not important. Like, that candle that you're or the green candle, the second to last candle, that one, is not. It's not important that candle wicked like the low of the previous one, right?
It's not.
We're not considering that.
No, yeah, exactly. That's why we're focusing on the current Q3. So,
Okay, all right,
and the Q3s, obviously, like, as we can see, they land differently on different candles. So going through an entire day from 1800, right? Why did these go up here? I must have moved them somehow, some way. Okay, so from 6 p.m., right? The first Q3 that happens is at 9. And then the next 4-hour candle that occurs, let me just put lines. So Q3 is happening here, but the 4-hour candle open is at 2200. So in this case, what this would generally look like in the form of what we're trading is that the manipulation will occur during Q3. And then when this 4-hour candle opens, it will likely be a return to the zone.
Okay.
And then we're looking to catch this expansion, right? So this would be 2 or 4 or 5. And then the next one, the 4-hour candle opens at 2, which I already have marked out. But then the Q3 happens at 3. So in this case, what would happen here is that we have, I don't know, we have a retracement happening, let's say, right, during this time frame here. And then when Q3 opens up at 3, we have an open, and it's just accumulating here. And then we have a high created during Q3, and then again, it creates a CSD in that we can return to the zone. All right, so then now we go to the next candle. So now 6 a.m. is our next 4-hour candle. And this did actually occur on Thursday, so you can refer to that actual price action as well. But in this case now, Q3 isn't until 9, so this will either consolidate here, which, or okay, we can actually use this as an example for Friday. Price action just consolidates, right? And then when Q3 happens, we trade above all of this price action and then trade lower. So we don't trade above the previous 4-hour candle, but we do trade above Q1, Q2, and then down, and then we do manipulate up, but there is no change in state delivery to, well, there is one here. Once we have this CSD here, we can technically take this as an entry, and obviously this one would fail. And this would just, as each quarter prints, we can only assume, okay, yeah, we traded above these quarters. This will be the Q3 manipulation. It changes state of delivery, but what is it lacking? It's lacking displacement, right? So we can't take it. Then it goes up and manipulates in Q4, and this one does actually have manipulation or displacement. And the CSD doesn't occur until there.
Okay.
Does that make sense?
Yeah, I guess I can't quite straightforwardly think about like what the 4-hour candles, like how we think about them.
The how we're thinking about them is that we just want to catch the expansion of them. That's it. That's all we're thinking, is that, because think about the sessions where they are. The London session is from 2 to 5. Well, that 4-hour candle is from 2 to 6. So we're just looking to catch the ride of the 4-hour candle.
Okay. Okay, thank you so much.
No problem. All right. Let's see here. What did I miss? Nothing. Okay. Any other questions? Or did I clear up anything for everyone? Or confuse you more? Okay. So we'll go ahead and hop in. Or sorry, no, we'll continue to go through the charts here. Go ahead and feel free to ask your questions. I'll wait. I can see you guys typing. Getting reps in with his daily chart and Discord video makes the concepts extremely straightforward. Yeah, for sure. I agree. Since all price action is fractal, can't we use the same process on the 1H time frame? Yeah, absolutely. You could. You can, so we're trading the model according to the way that it's meant to be traded, or what we're looking to test, right? Not that it's meant to be traded that way, but we're looking for the data that confirms that we can take this 5-minute change of state of delivery with the 4-hour expansion. There is no like, oh, it's proven it works. That's what we're doing. We're trying to prove that it works. All right. So we're pairing it up. We're combining all these ideas to see, does it work? We're not telling you it works. But you can use every single candle has an open, high, low, close, right? And so if you were to wait for the open, wait until it manipulated higher, and then waited for a change in state of delivery to occur within that high, then you can catch it down to the low before it closes. That's all that really is occurring in every single candle, which is why we utilize what's known as time frame alignment. So for, a 4-hour candle, we can refer to a 15-minute chart and a 1-minute chart. And, for a daily candle, you can refer to the hourly and a 5-minute. So Adrian's time frame alignment of 5 to 4 is actually unique to Adrian. Yeah, sure. Yeah, you can. I mean, you can trade it. You can test how you can test it however you want to trade it, Big M. So, for example, the trade that I took on Thursday was a 5-hour trade, and that's a normal trade for me. I'm looking to hold a trade for the 4-hour candle expansion because I'm looking to get off my chart by 11 a.m. So I want to catch really the 6 a.m. to 10 a.m. candle. And if nothing happens, before 10 a.m. for me to catch that expansion, then I can possibly catch the open of the 10 to get as much of the 10 a.m. expansion as possible. So let's refer to Thursday's action, actually. So here, I caught the trade in this wick, right? I got in at 9:55.75. So literally right around here, I was in this trade. I waited till it expanded down. 10 a.m. opened, and I was able to hold this as a continuation strictly on, like, we closed below the last 4-hour candle. I can expect that we're going to open high, low, close again and possibly reach lower because OTE of previous day was also lower. So here with OTE, oops, it doesn't show on this time frame. Hold on a second. OTE. Oh, I have it set to 4 hours. I have to change that. Hold on. Okay. So OTE, I have reason to believe that we're going to reach into EQ because we've already traded below 25% of the previous day. So 25% is here. We've already closed below it. I can expect now that we're going to reach into EQ. So then I can hold for the 4-hour open, high, low, close. And that's all I'm doing is I'm trying to catch the candle for its entirety. It's the same exact thing when you're trying to catch a daily range. You can catch the 1-hour change in state of delivery to catch the daily candles expansion. I don't think that's exactly hard to grasp. But if I can use different words to maybe explain it in a more simplified way, we're just looking to get in on the wick. And this is generally where the change in state delivery will occur, is in the wick of every single candle. And it doesn't matter what time frame you're using. That's what we're trying to verify, is like picking and choosing what time frames we're putting together. It's just that Adrian and I already trade a 5-minute chart, and it just so happens that we've noticed that these 5-minute deviations are generally the 4-hour expansion. It meets the entire 4-hour expansion. Why are they up there? Okay, I figured out what I did. I don't know, but they're at the bottom now. I don't know what I did there. So guys, if you guys have questions, feel free to drop them. Obviously, there's still more questions coming in, so we might as well knock them all out at one time, because asking questions will evidently lead to more questions, and then we can just all get it all out before we actually get testing, so everyone's on the same page. Yeah, I can't say that I think I'm using more technical or more advanced language than T-Trades, because I learned myself from T-Trades as well, so I think that I mimic him a lot in my explanations. No worries. We're still gonna go over charts because I think everyone has failed to do their homework, so I will do your homework with you. So going into the very next chart here, let's see, we did this daily review. So 1 hour SPS. So he saw here, this is actually when we, no, this is far back. This is in January. Wow, this is the same exact thing that's happening. Okay, so on the 1 hour, we have this change in state of delivery happening here. We have this break of structure, which is simultaneous to his change in state of delivery. A change in state of delivery, for the record, by ICT and by T-Trade's definition, happens at the open. But what Adrian has done is simplified it to match the swing low and the market structure shift. That way there's no difference between a market structure shift, a change in state of delivery, or a break of structure. For example, he just calls it one thing, and it's the change in state of delivery. All right, so we close below that swing low. We have the CSD. We have a pullback. This becomes 2. So 1 is a break of structure or the change in state of delivery. 2, we have the pullback. 3, we have an expansion through the previous low or previous high. Then 4 will come back and sweep out 2. Okay, so the only reason he didn't put 4 here is because it continued to expand. So we you don't have a confirmed 4 until you basically have that, you have a swing, right? So here it's all inside candles, and then we continue to expand higher. Then we have the 4, and this finally does actually have an expansion down below previous candles. So this candle is inside of this candle, these candles are all inside of this candle, and then we get finally a break above higher. So all of these candles are inside candles. And then we have 4, and then we have 5. 5 can sweep 4, it doesn't have to, and then but this, it forms in a failure swing. And then 6 is when it takes out 3. So this is what SBS is. This is a swing break sequence. This is a bearish example, so he had that on his hourly chart. I won't go over his trades. In fact, I'll just go over, oh, this is probably good. This is a weekly review. So this is how this is exactly how you can catch the daily expansions, for example. So in this instance, what we've done here, or what all ICT traders do pretty much, but what Adrian is depicting here, is that he's marked off midnight of every single day. Then he's marking out true day open, which is midnight of every single day. And then he's showing you within that framework where high of day and low of day printed. So the idea to catch the daily expansion is very simple. You're trading above or below midnight. You're waiting for that manipulation to occur above or below midnight. Once that manipulation occurs, you can take the trade until the day closes, pretty much, or whenever you want to hop off the chart is really the idea. So here our high of day is midnight. It returns to midnight on the singular candle here, and then just dies off. Low of day is created at 10. So if you're like me and you finish your day at 11, you would have caught the daily expansion. All right. Same thing here. To catch the daily candle, all you're doing is waiting for the manipulation above midnight. So we've traded up above it, we've now traded below it, and now you can take the trade into previous day low is basically the everyday target. So if you want to learn this the way ICT actually taught it, you can watch his Mastering High Probability Scalping series. But that's all that happens on every single candle. It opens, it manipulates above or below the open. As soon as you can identify that manipulation, as soon as you can see that we've traded above or below the open and now it looks like it's going to go up or down, and that's obvious to you, you take the trade there and you wait until the candle closes. That is literally what every single time frame does. No matter what time frame you're trading, that's whatever you can choose to sit there for an hour for an hourly expansion. You can choose to sit there for 4 hours for a 4-hour expansion or the entire session. Or you can choose to sit there all day and wait for that candle to close. That's really all that OHLC and OLHC is, right? The power of 3. Does 2 not need to reach back into the level line that confirmed the change in state delivery in order to be a 2? No, it doesn't. SBS is completely separate from change in state and delivery. It's completely different from Adrian's model. SBS in itself is a model. What Adrian has done is applied confluence to it. He wants 2 to be within a zone, or it's ideal. It's for us to take 2 as a trade. We want it to be within a zone or the CSD. But no, it's simply a pullback, followed by 3 that takes out 1. So yes, 3 would have to make a new low or a new high. Or it seems 2 is only confirmed by 3 taking out 1. Exactly. 2 only exists when that new swing happens. That's exactly it. It's only confirmed when the new low is created. Good to go, Yerm. Okay, great. Well, I mean, but it is completely separate. So like, let's refer to Thursday again. All right. So the swing break sequence that I took for my trade was this here. So we have 1 happening, right? Shoot. Good gracious. We have 1 happening here. Now in ICT terms, because I'm always going to provide confluence, we've broken below Asia low. We close below Asia low, right? Then we have this pullback. And then we have continued expansion. Okay? So now we have 3. I'm using the wrong line again. I meant to use this one this time. So 1. It has a pullback. It can continue to pull back, right? Until we get that close below, like right here, this looks like it can be a reversal because we closed above Asia high. It can go above London high and create a CSD there. So until we get this 3, we don't know where 2 is. And then we have 4, 5. So we had the sweep happen here. And this is the trade that I took. And then 4, 5 sweeps out 4. And then the 6 cents. Where do you typically put a price alert for number 2? Ideally, we want it to at least be premium and discount. So EQ of the range. So in this instance, it does not end up at Q2 or at EQ, right? And this is actually a signature, or this is a model in itself. When you have accumulation or low resistance liquidity building underneath EQ, right? Because then when you have this retracement, you know it's going to take out liquidity and just return to premium. And then so like as we expand though, now our range changes a bit, and so now 2 is above EQ. And then we have OTE of this range as well, but OTE would also be to 3. But the alert for 2, if you want to take it as an entry, would ideally return to premium. Yeah, exactly. Yeah. So you would put an alert for 2 after 3 has fully formed. So if after 3, for example, you have candles that are continuously expanding, then you don't have a swing low yet, right? But here at this point, when you have this bullish CSD, where is it likely going to? It's likely going back to sweep out 2. So then once you have this bullish CSD here, that's when I would place an alert at 2 to know that it's been swept. Yeah, exactly. I think that's what you're asking, right? Okay, sweet. I've actually gone over this in a really long video as well, where the concept of like ranges being created is that if you haven't returned to EQ at some point, it will. And when you have the change of state delivery, you can assume that it's going to go to EQ. And if it doesn't go to EQ, then you can then that range will keep expanding. And then once again you have a new swing to trade higher, you can basically just always target EQ. EQ is like the lowest hanging fruit ever that you can, like, that's not even OTE, right? So EQ is external range to internal range is what you're trading. That is like the definition of low hanging fruit. You're not even aiming for an internal or an external high. You're just aiming for the middle of the range, which is what? It's a mean reversion model for those who know that type of mindset. So this is the mean. You trade away from it, you go back to it, right? We trade away from it, we go back to it, and then over and over and over again. Okay, Yerm, any more questions cooking up? I'm not singling you out, but I feel like you have more. Great, yeah, no, we can just talk. Okay, great. Okay. Alright, I just had a friend confirm an appointment with me. So, we'll maybe go until 2. Alright, so next chart is market maker buy models, sell models, similar price action from August. I remember when he posted this. Alright, there we go. Next daily review is this one here. Alright, so... Okay, there we go. Now he's drawing OTEs on the chart. So this will definitely... And then here's OTE of previous day high and low as well. Okay, good, good, good. So this is... Oh, wow. Dude. Killer view. Where are you hiking at? I wish I could be hiking today. The weather is shit in Virginia today. Oh, nice. Man. What are you doing on Discord? Alright, so... I'm actually gonna put this chart up. What I want you guys to do is just look at this chart. Right? I'm gonna just marinate it in it for a second. If you're on a computer, obviously better, but if you're on your phone, zoom in and out of this picture, look at this picture and admire it, and try to go through every single quarter and every single session and understand what's going on. Look at all the different levels. I'll be quiet for like a minute while you guys do that, and then we'll go over Adrian's explanation of it. Alright, so This is pretty much a classic day as classic days come. So we have accumulation happening in Asia. We have a manipulation above during London. London creating high of day, and then New York ends up being a continuation of the London move. So that's why I wanted you guys to take a look at this and kind of burn it into your brain. This happens very often, albeit this is like very, very ugly price action for a daily expansion, but it does have like this exact framework happens all the time, where you have an Asia accumulation, a London manipulation, and then a New York distribution, meaning that New York will just be a continuation of what has happened in London. And when we get the close below Asia here, like we've taken the high of Asia overnight, and then we get the close below Asia all the way over here, and then we also, in the same exact instance, we have an open high low close occurring. Then you know, like once you have this manipulate or you have this accumulation happening again at Asia low, we have the 10 a.m. candle that just opened, right? And then we manipulate up into OTE of this range down. Then you can pretty much catch this 5-minute CSD within this. If you want to wait, or if you want to be aggressive, you can try to catch it, within here. So what has happened here in forms of SBS is you have a 1, 2, 3, and then it never comes back here for 4. Sorry. Yeah, there's no technical change. There's no market structure shift happening here. I was looking at this originally, but if we're looking at this for the actual structure on this current time frame, we have 1 breaking structure here, 2 as the pullback, and then 3 breaking lower. Of course, we don't know what happened here, but this 2 did go into EQ, just missing OTE, and then you're trading lower. Notice here in London we also traded above previous day high. So then when we have this 2 coming back, it actually comes back into 0.075 of previous day's range as well. So now let's look at Adrian's summary of this market maker sell model inside of New York PM range. What he's referring to is original consolidation here, smart money reversal, which he's listed out here, and then we return to this New York PM low. So he's referring to just this price action right here. Market maker sell models are a bit of an advanced ICT theory, so I don't want to get too deep into that. But then we have a Q2 change of state of delivery and displacement during Asia, Q3 consolidation, Q4 consolidation. So in Asia, we have this change of state of delivery. Now, remember what I said when we're trading counter trend, we normally achieve 1 to 1.5. So although this is expanding down, once we get to here, it's unable to expand lower. So then we have immediately following the inability to expand lower, we have this change in state of delivery. So now we have a new manipulation swing, right? This CSD occurs, it never returns back to the zone, but then we have distribution all the way up. Here is what he was talking about, this CSD, and then we have Q3 consolidation, Q4 consolidation. So just the inability to trade lower. Now going into London, go ahead, Yerm. I'm waiting. No question? Okay. Alright, so London expansion to standard deviation 1 of the Asia manipulation, SD 1.5 of the New York PM manipulation, change of state of delivery and displacement, and expansion to SD 1.5. Q2 continuation to SD 4, Q3 change state delivery displacement OTE into expansion to standard deviation 1.5. Q4 continuation to standard deviation 3. So in London, he's saying we first expand up here to 1.5, and then we expand up to 3 and 4. We did trade into the 1 to 1.5 of the PM session, and in this instance, up until here, this is still counter trend, right? Or these deviations are not being met, so we're only maxing out 1 to 1.5, which is, you know, a huge sign that a reversal is coming, and it does. We have this CSD here, and then we trade higher. What does he say? Q2 continuation to SD 4.5. So then right after that, Q3, we have the change in state of delivery occur. So once we close this low here, we do have a confirmed change in state of delivery, and then Q4 continuation to SD3, to standard deviation 3. And in this area of 2 to 2.5, we have this reaccumulation occur, which will send it in the next cycle more than likely. So then now, New York AM session, Q1 relatively equal highs are rated, and SMT with ES plus change of state of delivery and displacement. So in Q1, we rated equal highs. So notice we didn't take out previous quarter. The previous quarter is like huge, or the previous cycle is huge. So we just have equal highs here. Excuse me. And then we manipulate above those highs. So we just rated relatively equal highs, and we have SMT. Then we have a CSD. Now this actually brings up a question for me that I need to ask Adrian. Is he considering a manipulation as just above TMSO, or is he considering it for manipulation above previous quarter highs like Q1, Q2? So I need to ask him this question. So I'm glad that we're doing this. So he says here manipulation above TMSO, which would be Q2 here, this Q2 open. So we have this manipulation up above it. Then what does he say? OTE back to TMSO is what Q2 did. So we return to OTE of this range down, and we manipulate into the zone as well as above TMSO. Then we have Q3 manipulation above TMSO, change state delivery, and OTE. So in Q3 is when all those conditions are met, and then we expand lower. We have the change of state delivery here, and then we return to OTE again before making new lows here. So this is actually, I can't quite see if we get this sweep here, but this is a nice SBS as well if we do get that sweep. So 1, 2, 3, and then we don't sweep 2 until here, and we go back. And again, we are now, when we expand this range, we now have swept 0.79, which is this level is coming up a lot for like the most optimal entry, the most optimal like soup level is how ICT teaches it. So we're really interested in studying this level. Between Adrian and Frieden, we've seen that level hit a lot. And then Q4 is just a TMSO retracement into OT, which I already went over. I front run that a little bit. So now PM, sorry guys, hold on a second. I need to go clear myself. Hold on a second. Alright, sorry about that. Okay, so PM session now. OTE retracement into continuation. Q2 expansion to standard deviation 4 plus TDO retracement. Q3 manipulation above TMSO, change state of delivery displacement, and expansion to standard deviation 2.5. Q4 consolidation. So PM session here. So return to OTE, then TDO here. Q2 is a return to TDO. And then Q3, we have the expansion into 4.5, Q4 consolidation. He says that he mentioned yesterday actually that Q4 consolidation is pretty much like that's every single daily summary that he does. OTE is OTE are these retracement levels which you can put on your fib. So these are the settings, big M. OTE is how and why ICT is so famous. This level here, 0.705, is the optimal trade entry level that he came up with. So 0.618 is a universal retracement level known as the golden pocket. 0.705 is the level that ICT says that he found, or that he noticed. He has a whole series on it called Optimal Trade Entry Series. And there's like a whole playlist of optimal trade entry recognition pattern where he just has like these short clips of you looking at a chart and you have to guess or estimate where you think OTE is just by your naked eye. And then he pops on the retracement levels to show you if you're right or wrong. And then 0.79 technically is an institutional level because it's the 80 level. I don't know the significance to ICT in this regard, but the idea is that when you have a range expand down, which is normally a change in state of delivery. So let me back this up here. You have blah blah. We trade up above and then we trade lower, right? We've broken structure here. And so then now you have this range, which is what he used to call the impulse leg. And I used to be like, what the F is an impulse leg? Why can't you just speak regular English? What is an impulse leg? It just, and then, then he starts using the word displacement. What is displacement and an impulse? What are you just trying to say? So for me, I just say speed up, speed down. Movement up, movement down. We have a swing high. We have a fair value gap. We normally have a fair value gap on one side. And then we have a fair value gap on the other side. And that generally signifies speed. So speed up above the range and speed below the range. And so this pocket here is known as the optimal trade entry zone, in which you can enter wherever you want within this pocket. What he says is like low-hanging fruit for an entry is 0.618. You can enter at EQ, but you really want to wait for 0.618, he says. But that optimal trade entry was like no drawdown. That's 0.705. But I've found for sure that 0.79 is definitely the no drawdown entry. It's just that the probability of it getting to 0.79 is much lower than it getting to these first two levels. So you have to have some real patience if you're waiting for this level, because you're going to see a lot of trades go without you, is all. And generally what we're seeing as a collective group between Adrian, myself, and Freedent is like in the form of SBS. It looks like this. We have 1 and then 2. we'll miss EQ or just tap EQ. Then 3, right? So now your range becomes bigger, which I'll move OTE in a second. So it'll go to EQ, let's say, and now you have a new range because it's expanded lower. And then it'll go back to OTE, and then this soup level will happen at 0.79. And this is like the ultimate entry is what we're finding. So let's say I expanded this down, so 4 or 5 happening at 0.79. Do BPRs usually fall around the 0.79 level? You would have to test that AC. I haven't tested that. I don't know. I have no idea. Do you personally get the sense of invalidation? Oh, I might be wrong. When price, of course, 100%. But that, I think that is the essence of what we're all trying to fight, right? Because that is the best time to enter, is when we're like, oh shit, I'm wrong, right? And then it's like, oh man, it came all the way back up here. It's gonna take me out. It's gonna run my stop, right? But that is the best time to enter, 100%. When price exceeds, yes, exactly. Like that, and JD is a good example of like just completely throwing that thought out the window. Like he's just freaking top ticking it all the time. And he's like, we're all like, oh no, he's like, this is like super risky, right? But he's like, yep, I'm gonna add on, and that's the feeling that we're all trying to fight. Is like, oh my gosh, I'm so wrong. But that if you're right, if you choose to take it when it's like in this area of retracement, then that's a really, really good entry. If BPR is above 4, I'm loading the boat if 5 sweeps 4. Yes, that's a good point. That is a very good point. So like if there's a BPR here, that is a really good point. Above 4. Would it be good to measure 2 to 3 standard deviation for trying to match OTE with the projection? 2 to 3 deviation for OTE? No, I don't think so. Because so there's a model that I used to trade, or I do trade this still, but it's really the context of the market maker buy model, so or a sell model, right? So it's not just this to this, like you just broke out of structure and now you're returning to a premium and discount. My model, or how this is traded in like daily context, because this is what Adrian is really teaching as well. We're just all kind of looking at it in different ways. We're internalizing price in a different way. I actually tweeted about this quite frequently 2 years ago, but this is what a market maker sell model generally looks like, right? So you've created an entire range. This is the day. We have a daily range now. Previous day high, previous day low. Or sorry, opposite. Previous day low, previous day high. And now we think we're bullish. So then from this deviation that's occurred here, usually in PM session, we can take it to 2 standard deviations, which will naturally fall at OTE. So the invalidation of this, because, or what you need for context here is you need a consolidation and you need a smart money reversal, right? Now where I'm wrong is when we start to consolidate below EQ, we tap EQ and we trade lower, right? Because then that becomes a market maker sell model. Ideally what we want to see from this for continuation is we return lower, just like we did here. And then once we get to this area, we manipulate back up. And that would be what a continuation model looks like. So this would be 1, 2, 3, 4, 5, and then higher. So let me remove, I can't remove that half. But you know, this is where the 2022 model plays out in this first example. The example that I've selected here is where this is an actual 2022 model. The quote-unquote failed 2022 model, which is SBS, would be this playing out, where we think we see a reversal here, and then we take this entry, and then we get ran through. Yeah, and I've 100%, I don't know the keywords for you to search for my Twitter for this, but this is basically it. Standard deviations into OTE. That is like the framework of all frameworks. Does that answer your question? Nicholas? I did record this. Okay, sweet. Alright, guys. You guys have exhausted me, not gonna lie. Any questions? I feel like I'm just talking and talking and talking, and these sessions actually suck. Lecturing is exhausting in my opinion. In my humble opinion. And no, it's okay, Yerm. It's okay. Sweet. Okay, so I'm gonna hop off, I think. But I'm happy to answer more questions if you guys have them like immediately. If you're seeing Wild Berries, this community stream happens every single Tuesday, Thursday, and Saturday. As long as there's a stream happening within this channel, you can see them and you are allowed to access them. Yeah, that's true. That's a good point. January price action compared to now is insanity. I mean, I'm absolutely loving it though. I will say this is, and what I was trying to emphasize on Thursday when I was sharing my trade with everyone is that you really just have to live through the tough times and manage your risk until you get to the price action that suits you, right? Because I was having a discussion with Tyrant, and he's asking, he's like, dude, you know, because we both came from a server before this. We were both in that server. We have similar foundations. We both trade ICT. So and so I double that. I second that, Yerm. So, and I mean, Wild Berries, if you're still listening, as long as you get a payout, you earn the payout train bonus, and then your membership is free. We're paying out $25 a month, a bonus this month. So if you achieve one single payout, we pay you for getting that payout, and then the $25 that you've paid to be in the group, you've received that back. So, well, if you're in a great mentorship and you're visiting other streams, that speaks volumes. So with that being said, what I was talking about with Tyrant is that he's like, dude, like, I can't with these ranges. These ranges are insane. And I was saying to him is that like these markets move in cycles, right? So right now this price action suits me very well because I love to hold trades. But there will be a market cycle in which we are arranging a lot. We are just consolidating a lot. And that is the market where he will start to flourish and I will start to fail and I will start to have a lot of losses, right? So you have to manage your risk in conditions that do not meet your style of trading until you get to markets that, or market cycles that fit well with how you trade. And then when that time comes, you simply maximize those trades and you maximize your profits as much as possible. That's all that's really happening here. Like, it actually makes me sick to my stomach when people approach me and they say, oh, what model are you trading? Like, whenever I share profitability, which is why I don't do it often, oh, what model did you use to get this? What model are you trading now? I'm still trading my same exact model. It's just working better in these markets than it did in the markets happening in January. Is trading that's more or less what I just said, Jerome. And then yeah, and so with that being said, that's really it. You know, like, if these markets don't suit you, then just learn to manage risk with your model. It doesn't necessarily mean that you have to trade your model. or you don't have to, sorry, you have to change your model, I mean. So yeah. Alright guys, I'm gonna hop off here. Happy Saturday, go touch grass, go live your life. The video recording will go up at some point during this weekend. Cheers.